An uncertain economy meets the promise of a vaccine, and markets pretty much take the over on that bet. Welcome to Bloomberg Wall Street Week. I'm David Westin. This week, contributors Larry Summers of Harvard, Gillian Tett of the Financial Times, and Stephanie Flanders of Bloomberg Economics.
Many governments around the world, the UK, the US, have a mountain of debt higher than they've ever had before.
Roger Altman of Evercore.
We could see an extremely strong second half of 2021.
Dan Yergin of IHS Markit.
Oil price has basically been stuck in what I call the virus alley, and like a lot of other parts of the economy.
And Austan Goolsbee of Chicago's Booth School. An air pocket. That's what some people say the economy is headed for, as dramatic increases in COVID cases and hospitalizations and deaths trigger more economic damage.
It's time to hunker down. It's time to cancel everything. And if it isn't essential, don't do it.
Even as the prospect of a vaccine by the middle of next year gets ever more certain.
This is the weapon that is going to win the war. And that is the light at the end of the tunnel, right?
And a cushion for that air pocket in the form of a stimulus bill seems to be what's needed, bringing the two sides back to the negotiating table, focusing on a compromise proposed by senators on both sides of the aisle, and the President-elect Biden said would be a down payment on what's needed.
Any package passed in this so-called lame duck session be now on January 21st. At best, is only going to be a down payment.
Markets? Well, markets pretty much look to the half-full part of the glass, with the S&P pushing toward new highs, leaving us to ask whether they're seeing what's around the corner or seeing what they want to see. And to help us figure out which that is, we welcome now Wall Street Week contributor Gillian Tett of the Financial Times, where she is chair of the editorial board as well as editor-at-large for the United States. So, Gillian, welcome back. Great to have you with us always. So which is it? Are markets really seeing around the corner, seeing things we might not see, or are they just wishing themselves to success? Because we do have conflicting signals going on here.
We have completely conflicting signals. And you know what? Just a couple of minutes before I came on air, I was checking my Twitter account. So we have Donald Trump saying, stock market reaches new all-time high, exclamation mark, of course. Joe Biden saying, to everyone who is struggling, I promise you help is on the way. And that really captures this tale of two cities, that you have the stock market going absolutely wild on the prospect of not just the hopes of a vaccine coming in next year and unleashing an economic boom, a bit like the roaring 20s after the last great pandemic, but also the fact that that's coinciding with a lot of stimulus, not just the fiscal stimulus that everyone's discussing in Congress right now, but also the incredible amount of monetary stimulus that's out there already. And you put those two things together and you can see further down the track the prospect of quite a big rebound next year. The problem, though, of course, is that right now, as President-elect Joe Biden knows and was talking about today, you have a lot of economic pain in America, particularly amongst people who do not own equities and do not have assets, who are seeing the fruits of this boom. And that is the real tension. I mean, the jobless numbers today were pretty poor. And so that is going to be weighing heavily. And the big question for the administration is, how can they help alleviate the short-term pain without unleashing potentially a destabilizing recovery next year that could actually pave the way for inflation?
Gillian, as you say, the jobs numbers we got this week were disappointing. They were below what we thought. There's a slowdown in the growth of jobs. And that's before, really, we have a lot of the shutdowns that are being done right now and are about to come. That was as of the middle of November those numbers were for. The question in part is, if we are having a bridge to this brighter day that we believe is coming with the vaccine sometime in the middle of next year, can we do real fundamental damage to the economy, maybe irreparable damage, in the meantime?
Well, there's been a lot of hope amongst policymakers that the economy was like a laptop. And we all almost unconsciously borrow the laptop metaphor to describe what's happening, because we're so used to this idea if something goes wrong with our laptop or our phone, we simply just switch it off, reboot it, and it starts up again identically. And that's been the metaphor a lot of people have wrongly borrowed, including the government, to describe what was going on. The reality is that actually, since our economy laptop has been switched off, All kinds of damage has been done to the software, and that just is not going to be able to be reversed quickly. There's good things happening as well in terms of the digital penetration. And that's a lot of what the things that the stock market is celebrating right now, the fact that tech has become so deeply embedded and accelerated in terms of the transformation in the business community. But certainly there is a lot of pain. I think the Biden administration is going to try and alleviate the pain through short-term fiscal support, through essentially providing payments to households in America and hoping that the vaccine come through fast enough to try and reignite animal spirits early next year. And I personally think there's a good chance that will happen. But the timing challenges right now are very tricky. And they would have been tricky even if we weren't in the middle of a presidential transition. The fact that we are, and the fact there's so much obstacles to creating a smooth transition, is going to make the question of timing for the next 6 months truly fascinating to watch as a journalist and a bit of a nightmare to navigate as an investor.
Gillian, you wisely say it's not just the next 6 months, but it's the longer term. When you talk about digital penetration, that's likely to stay with us a lot longer than 6 months. You had a fascinating column in the Financial Times this week talking about globalization as well, that a lot of people have sort of almost counted out, saying really it's on the decline given what's happened. By the way, that was happening even before the pandemic hit. But your column suggested, no, it's not that simple.
Well, one of the things that really irritates me is people say, we're seeing the death of globalization, or I hate globalization. That's been a big mantra of politicians and voters for a lot of the last couple of years. And the reality is that that G word isn't just one thing. There's actually at least 4 things you're talking about with that word: the movement of people, money, goods, and ideas. And if you break them down, as a report from NYU Stern Business School and DHL has done this week, and it's a fascinating chart, it's one of my favorite economic metrics to watch. If you break that down, what you can see is actually trade globalization has been flatlining and falling slightly for the last few years because of protectionism, US-China trade war. Money has followed a similar pattern after 2008. The people aspect was rising until, of course, this year it's collapsed because of the lockdown. The really important thing that everyone ignores when they talk about globalization usually is ideas and information. That has exploded, and it was exploding even before the pandemic. But what's interesting is in 2020, the movement of ideas and information has accelerated. That's one reason we actually have the vaccine coming along, because of all this cross-border swapping of ideas. It's the reason I'm talking to you right now, David. And I think that, combined with what I do think is a chance of a rebound next year, is going to actually put globalization back into favor, or at least give it more legs next year. Yes, this year the index shows it's fallen back, no surprise. But actually, I think anyone who's talking about the death of globalization is probably wrong. And you should ask them, if you hear that word, which one do you mean? Because if you're talking about the death of globalization, or you're reading about it online, you're actually taking part in globalization without even necessarily recognizing it.
To reduce it down further than we can, in a word, is data the new oil?
I think data is certainly one of the things that the new oil, and the question who controls it, understands it, and manages to leverage off it is going to be a winner.
There you have it. Thank you so very much to Wall Street Week contributor Gillian Tett of the Financial Times. Coming up, the split screen of the American economy, a frightening COVID surge, and the start of vaccinations just around the corner, with Roger Altman, founder of Evercore.
Here, we have a more temporary but acute need than we had at the beginning, for example, of 2009.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Jay Powell this week told Congress that the U.S. economy was facing a great deal of uncertainty in the short term, even as the prospects for a vaccine mean good news in the medium term, leaving us with what former Treasury Deputy Secretary and Evercore founder and senior chairman Roger Altman called a split-screen economy.
We have an unusual split-screen character to the economy today, in the sense that the period between now and full distribution of the vaccine is a period of acute need. And post-vaccine, and I do mean post-universal distribution of the vaccine and post-vaccination of a high percentage of Americans, we should see strong growth. Now, it's interesting that this is very different than the conditions that Mr. Biden found upon becoming vice president in 2009. It's a really interesting contrast. At that time, the stock market was falling, unemployment was rising, the economy was weakening, and the worst was yet to come. Today, it's quite different. Unemployment is falling, the economy is moving into recovery mode, albeit fitfully. The market is rising, and the outlook is better. And so here we have a more temporary but acute need than we had at the beginning, for example, of 2009.
Roger, let's turn, if we can, from your role as economic statesman to your role as head and founder of Evercore for a moment. Give us a sense of how the C-suite is reacting right now to the Biden transition. What is the sentiment in the C-suite? Are they in a panic about possible taxes and need to get deals done? Are they looking forward to more stability? What's their attitude right now?
Well, let's just step back a moment to a month ago today. A month ago today, we were within a day or two of the election. And today, a month later, the reaction of at least the large-scale business community in this country is one of giant relief. There's no doubt about that. The business community is looking forward to a period of greater predictability, stability, more thoughtful approach to governing, and the like. So the answer is lots and lots of relief. You have different views in the business community as to whether they think divided government with the Senate in Republican hands and the White House in Democratic hands is a good thing or a bad thing. Some think it's good because it imposes limits on what can be done, and some think it's bad because it means gridlock. But generally speaking, the business community is very much welcoming this new administration. No doubt about it.
Roger, are you seeing, or might you anticipate the possibility that at least for some CEOs, their eyes might turn overseas more than they did under the Trump administration? Because there was a lot of trade strife. We know there were a lot of issues, a lot of sanctions, things like that. It appears that may ameliorate somewhat. And also we see actually right now, we're seeing the stock markets, for example, overseas really come back strong. Does it open up more international deals?
At the margin, yes. But David, keep in mind that if you are a multinational with, say, for example, half your revenues outside the U.S., you don't have the alternative of paying less attention to your non-U.S. business. You have to. And you have to do that whether Donald Trump is president or Joe Biden is president, whatever is going on in the Congress and so forth. At the margin, yes, I think, again, the business community will welcome a greater degree of predictability and stability and a less tariff-centered international economic policy. They're going to welcome that because the tariff-centered approach that President Trump used did not work very well. Just look at the way China managed to succeed despite it. And so I think the answer to your question at the margin is yes.
We talked earlier about what looks to be good news on the horizon sometime next year with a widely distributed vaccine. Is the business community, and particularly the leadership of the business community, are they anticipating a possible, let me call it snapback, that in fact things might get better really fast after that happens?
Well, it depends a bit on the business you're in, of course. But I think the answer, generally speaking, is yes. We could see an extremely strong second half of 2021. And I think the stock market is anticipating some of that with this recent additional run-up. The market in November rose more than all but 4 or 5 months in the history of the stock market. I think it rose 11% in November from memory. I might be wrong slightly on that number. But so I think the answer is yes. And if you look right now at housing, and you look, for example, at autos, they are very strong right now. in a way that you really wouldn't have anticipated looking back to March when the virus erupted, the lockdowns happened, and so forth. And consumer spending and the early data on Christmas sales between e-commerce and traditional brick and mortar retail is fairly encouraging. The economy is not doing nearly as poorly now as you would have thought it would 7 or 8 months ago. And that's because while the shock to the economy was massive in the second quarter, we had the largest decline in GDP ever recorded, the policy response was also massive, monetary and fiscal.
That was Evercore Senior Chairman Roger Altman. Coming up, we're down to the wire on Brexit. Bloomberg Senior Executive Editor for Economics Stephanie Flanders on what's at stake.
It's amazing how important this 0.1% of the economy, the fishing, has become in this negotiation.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Less than a month to go until the United Kingdom leaves the European Union with or without a deal. After years of back and forth, it's hard to see how the parties have truly narrowed their differences over harmonizing regulations, over the Irish border, or over those fish. As Wall Street Week contributor and Bloomberg Senior Executive Editor for Economics Stephanie Flanders says, it's time to make some decisions.
The mood music the last few days has actually been less positive. And I think that's partly the feeling that, hang on a minute, we thought we knew what needed to happen. You mentioned those 3 deals. You know, the general perception is that on those 3 sticking points, it's Britain, probably Boris Johnson himself, who will need to give a little bit on this language around a level playing field, where Britain sort of promises that it's not going to try and use its new freedom to get an enormous competitive advantage against Europe, in return for the Europeans then asking for what the British would say was a more reasonable amount of access to British waters. It's amazing how important this 0.1% of the economy, the fishing, has become in this negotiation. And of course, many in the financial sector, the city's so important, would say, hang on a minute, we were sold down the river years ago and you're still, the fishermen are still in there battling away for their rights. It does seem like a very topsy-turvy negotiation.
Yeah, as we would say, them's politics is a practical matter. But we have the British on the one side, and I think it's fair to say the British position has not always been perfectly consistent. But on the other hand, are we having dissension over on the European side? Because now there are reports that maybe they don't think Michel Barnier is really cluing them in on what the terms are. There was even a Bloomberg report saying that, in fact, France might be threatening to veto whatever Mr. Barnier negotiates.
You know, the French have always had have been the sort of the muscular side of the negotiations, and certainly have had more muscular rhetoric, feisty rhetoric throughout this process. We know they've quite actively talked about taking advantages for Paris's financial sector for this, for sure, but also about Britain being absolutely sure that Britain doesn't get a deal that any other country might look at and say, oh, I want one like that. Whether that's sort of classic, not to play to too many stereotypes, but is it the sort of Gallic desire to sound macho, or whether there's something more fundamental there, a real disagreement? I'm not so sure. I mean, what has been really striking throughout, you pointed to the inconsistencies on the British side. In general, the Europeans, this is a lot of countries with a lot of different interests in this negotiation, have been remarkably of one voice throughout. And I suspect that will continue, even if you get a little muttering around the edges. We've
been talking about the possibility of an air pocket, as it's called, where we really have to get through, here in the United States, a very difficult period appears on COVID-19, with the expectations by the middle of next year, things may bounce back rather resoundingly, provided we get this vaccine distributed. But one of the things we're contending with, as you know, Stephanie, is fiscal versus monetary. You've got that pot of money on the fiscal side, as I understand it, but you're having some trouble getting it distributed. Is that right?
I think and certainly in the case of the EU, they've got their recovery plan, which we've talked about in the past, is a great breakthrough, because it involves lending on behalf of all of the Eurozone members, and then lending out, giving in some cases, and lending to European countries, large amounts relative to their GDP in the case of Greece and Spain.
And what is the sense over on the European side of how you get demand going again? Because you can offer money for free until the cows come home, but if people don't want to borrow because they have nothing constructive to do with it, they're not going to borrow it.
Yeah, I mean, this goes to, I think it's internationally, we're just having a reassessment of the power of fiscal policy. It used to be said that it was monetary policy that could be nimble and that could support kind of short-term growth or stamp on short-term growth if you were worried about inflation. And fiscal policy was too slow to do anything really useful. You'd end up building a bridge in 5 years' time when you don't need it. Really changed our view on that. And we've had, in fact, on my podcast, Stephanomics, we had Jason Furman this week, the former Obama Council of Economic Advisors president, talking about the need for a revolution in the way we think about fiscal policy, and fiscal policy playing a much bigger role in future in supporting growth in a world that we don't have to worry so much about the cost of borrowing. If your government at the moment, many governments around the world, the UK, the US, have a mountain of debt higher than they've ever had before relative to the size of the economy, but record low debt service costs. The cost of actually having that carrying that debt is lower than it's ever been. Should change the way we think about fiscal policy on both sides of the Atlantic.
That was Stephanie Flanders, Bloomberg's senior executive editor for economics. Now it's time for a Global Markets Week in Review.
David, after a rocky Monday, little turbulence for Asian markets at the start of December, with the regional index clocking fresh highs despite news of Pfizer's vaccine output shortfall to end the week, which investors took in stride given bets for sustained growth and dollar weakness going into 2021. The latest salvos from D.C. against Beijing didn't leave a big dent either. Congress passed legislation restricting Chinese listings, and the Pentagon added 4 more Chinese companies to a blacklist. Yet a survey indicating that most global funds still plan to increase their exposure to China next year. An appetite for Chinese IPOs still red hot. Telemedicine player JD Health raised $3.5 billion in Asia's biggest healthcare IPO ever. Shares are set to start trading in Hong Kong on December 8th. Danny?
Thanks, Sophie. Well, this week, the UK became the first Western country to approve a coronavirus vaccine, clearing the way for the Pfizer BioNTech shot to start being administered as soon as the next couple days. That helped give a lift to UK assets, despite the fact of the ongoing Brexit negotiations over the week, and France threatening a veto if they don't like the deal. And that's what we'll be keeping an eye on for the next week. Any updates there? Scarlett?
Thanks, Danny. The big story this past week, the emergence of a stimulus proposal that crosses party lines. The $900 billion plan splits the difference between what Democrats and Republicans wanted, and there is now renewed urgency to get a deal done before the year end, following a weaker than expected November jobs report. We'll be watching for more signs of compromise there. Also in the coming week, a pair of high-profile startups go public. Airbnb and DoorDash will take advantage of the record stock market to sell shares for the first time. Investors will also be monitoring the FDA meeting on COVID vaccines to get a better idea of the timeline and availability. And Costco and Lululemon report quarterly results. David, back to you.
Thanks to Sophie, Danny, and Scarlett. Coming up, President-elect Biden names the leadership of his economic team, and first on the list remains getting some immediate stimulus through the Congress.
If you look at the incoming Biden administration, they're probably going to put some significant focus on try to get as much direct relief as you can, as early as you can.
This is Wall Street Week on Bloomberg. This week, President-elect Joe Biden introduced the key players he's asking to help him get the economy back on track, led by former Fed Chair Janet Yellen, his nominee for Treasury Secretary.
It's an American tragedy, and it's essential that we move with urgency. Inaction will produce a self-reinforcing downturn, causing yet more devastation.
When she led the Federal Reserve, her patient approach to raising interest rates helped the economy recover from the aftermath of the great financial crisis, a record that has won her support from both sides of the aisle.
We worked extremely well together when I was in the White House. I find her to be very practical, very pragmatic, have a very deep and broad understanding of the U.S. economy.
President-elect Biden also chose 3 progressive economists for the White House Council of Economic Advisors, to be chaired by Cecilia Rouse of Princeton, a labor economist whose focus is on income inequality.
This virus has exacerbated the inequality that already existed in our economy. So in February, when this first hit, our unemployment rate was 3.5%. And so it was overall doing pretty well, but there was inequality. There were some cracks in the system. Not everybody was doing as well as others.
President-elect Biden's pick for director of the Office of Management and Budget is the one drawing questions, if not fire, from Republicans. Neera Tanden worked on the Affordable Care Act under President Obama, and she went on to head a progressive think tank.
Now it is my profound honor to help shape those budgets and programs to keep lifting Americans up, to pull families back from the brink.
As the White House budget chief, Tanden would have to find the money to pursue President-elect Biden's ambitious goals while dealing with a rapidly rising national debt. The pandemic pushed the U.S. budget deficit to $3.1 trillion this year, the biggest shortfall compared to the size of the economy overall since World War II. But before they can address things like the deficit or economic inequality, the president-elect's economic team will have to focus on the immediate need for stimulus. This, according to Austan Goolsbee of the Chicago Booth School, who served as chairman of the Council of Economic Advisors under President Obama.
If you look at the incoming Biden administration, they're probably going to put some significant focus on try to get as much direct relief as you can as early as you can because the economy needs it. Now, one difference is in 2009, that was traditional stimulus. The U.S. government's going to spend money, try to get growth jump-started. This is different. I mean, this is a temporary wave that's spread over us, and we basically need to figure out a way to hold our breath for 6 or 8 months until the vaccine can be widely available and we can go back to doing what we were doing before. So our goal is to try to prevent permanent damage, which is a little different from stimulus.
We now have at least the key players in President-elect Biden's economic team, led, of course, by Janet Yellen as Secretary of Treasury, but a fair number of other people, many of whom you've worked with, including in the White House. People are trying to read into it exactly how progressive his economic policies are going to be. What do you read into it?
I found the team really impressive. I mean, Janet Yellen is a rock star, of course, and well known. But down the line, if you look at the people they're appointing, they have experience. They're low drama people. I think the thematic focus, if you had to say, is there a thematic focus? Certainly at the Council of Economic Advisors, you got a heavy focus on workers with experience on wages, on training, on contingent workers, and it shows an emphasis on wages and workers. As to what does it mean for the agenda, of course, all of that hinges on what happens in the election, and are Democrats going to control the Senate or not control the Senate, because that will have a heavy influence on what they can actually do in legislation.
Austan, you make a very important point, I think, that the names I've seen so far, there is an emphasis on labor economists, some very distinguished labor economists, no question about it. At the same time, do they have enough macroeconomists? Is that a possible weakness of this team? Because you could have problems come up if you've seen that are outside the world of labor, and you need a really crackerjack macroeconomist in there.
Yeah, I mean, you always have to cover more topics than you have people. I would imagine as they fill out the team, you'll have more focus on tax and budget. You'll have more focus on macro. Several of the people that they're talking about, Jared Bernstein, Heather Boucher, do have some macro exposure as well as the labor economics exposure. I think the Janet Yellen at Treasury, in a way, serving as your Babe Ruth, it gives you some. There's nobody knows more about macro, nobody knows more about international, about banking than the former chair of the Fed, who's now the Secretary of the Treasury. So I do think they kind of got themselves some breathing room for whatever other focus they want to have.
Nobody's going to question Janet Yellen's competence as a first-rate economist. At the same time, there's another part to that job, which has to do with foreign diplomacy and sanctions and things like that. How's she going to cover that base? Because that's not something she spent a lot of time on.
Yes and no. The number two at Treasury is somebody who's got a heavy international focus. And she's known, unlike most, she's got to be the most internationally recognized Secretary of the Treasury in a very long time. I mean, from her connections, having been the Fed chair, I would think that the international issues are not going to be foreign to her. They're going to be somewhat familiar. And to the extent that in the last 2 weeks you've seen a blow up in the relationship between the Fed and the Treasury at a moment when you kind of don't want blow-ups in the relationship between the Fed and the Treasury, that would give you some comfort.
That was Austan Goolsbee, professor of economics at Chicago's Booth School. Coming up, OPEC Plus decides to ease off the brakes, but very gradually. We talk with Daniel Yergin about what difference it will really make.
Saudi Arabia has one view, Russia another view, the UAE another view. But I think that they could not afford to not have a deal.
This is Wall Street Week on Bloomberg.
We think that energy prices are at equilibrium somewhere in the high teens, low 20s. I also think it's a little bit of a hedge. We have seen a very sharp reduction in energy prices. By the way, that is stimulative to the economy, so thank you for that.
That was Abby Joseph Cohen of Goldman Sachs on Wall Street Week back in 2002. 18 years later, the price of oil is double what it was back then, and we don't look at low oil prices so much for how they can stimulate the economy as for what they may say about the strength of global demand, particularly in the time of the pandemic. Daniel Yergin of IHS Markit wrote the book on oil, and we asked him whether this week's latest OPEC Plus agreement to gradually ease production curbs is what the market needs.
What it does is basically says that the deal is not going to break up. When you have 23 nations that come together and looking in an abyss at negative oil prices, they make a deal. Everybody sticks together. As prices start going up, people start looking at their own interests. Saudi Arabia has one view, Russia another view, the UAE another view. But I think that they could not afford to not have a deal. And there were a lot of digital bilaterals that had to happen to make this happen. But this kind of is a gradual one that does ultimately get to what they'd agreed to in terms of bringing production back. But it just shows you, David, how hard it is to bring 7.5 million barrels of oil over a year back into the market.
Exactly, particularly given this market. Just one part of, forgive the expression, Kremlinology here. I'm hearing some people say it was important that Russia was presiding. They were chairing the meeting rather than Saudi Arabia. Do you put any stock in that?
I think so. I think Minister Novak was one of the architects of the whole deal, the Russian, and the Saudi co-chair, the petroleum minister, Abdulaziz bin Salman, decided he didn't want to be in the chair. And so the figure of stability was somebody who's not part of OPEC, but part of the non-OPEC group. So it sends a message about the Russians' focus on stability.
So they had to delay the meeting because there was enough contention. They couldn't really get to an agreement quite. And the contention, as I understand it, came from a quarter that I didn't appreciate, which is Saudi Arabia and UAE. Usually I think of it as Saudi Arabia and Russia. What was the bone of contention between Saudi Arabia and the United Arab Emirates?
Yeah, actually Saudi Arabia and Russia has been the basis of this whole agreement from the beginning. The UAE has said that they want to increase production. They didn't like the fact that other countries were cheating. They seem to they've raised questions about what's the framework here. I think they want to monetize their oil. So there was a degree of tension between those two countries in terms of their point of view, which normally they're pretty much in lockstep. So that's an example of the divergence of interests that exist, particularly as prices start going up again in anticipation of vaccine.
Well, that's key. It seems to be, as you say, the prices started going up again, because I took a look at oil over a period of time over the course of the year, and it has been moving its way back up. Is that really triggering the dispute right now about whether to increase production?
Yes, because I think when prices start going up, the divergence of interest. I mean, the oil price has basically been stuck in what I call the virus alley, and like a lot of other parts of the economy. And in terms of getting out, it's been torn between, on the one hand, now vaccine optimism, and the other hand, virus pessimism. But as it's now basically looking towards the springtime, when it's possible that a lot of people in countries where you have had economic shutdown, like the United States or Europe, will be back in motor cars and demand will be going up again.
Dan, we spend almost every day looking at the equity markets, at least here in the United States, and how they've been going up. And it's generally thought that's because we are anticipating a vaccine sometime at least toward the middle of next year. Does the oil market work that way? I mean, are oil prices being affected already by the prospect of a widely distributed vaccine by the middle of 2021?
Absolutely. It's signaling it, and that's when you'll start to see demand going up. Of course, there's some things hanging out there. For instance, if the Biden administration starts to move to try and reopen the door with Iran, that could mean a lot of Iranian oil coming back into the market. So there's a whole geopolitical drama that's happening at the same time. But it's certainly expectations of a vaccine and kind of confidence and hope beyond what looks like a very difficult 12 weeks that we have ahead from a health point of view.
That was Daniel Yergin, author of The New Map: Energy, Climate, and the Clash of Nations. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Every week, we wrap things up with our special contributor, Larry Summers, Harvard. So, Larry, welcome. I must say, this week it strikes me that the big developments were on the fiscal side rather than the monetary side. We did hear from Jay Powell, who said there was some uncertainty about the economy, but it was really apparent progress toward a compromise on some fiscal stimulus around that $908 billion proposal from some Democrats and some Republicans in the Senate. Is it possible that, in fact, the Republicans have been right all along and that we shouldn't have done the $3.3 trillion last spring, and it was right to wait because $908 billion may be enough?
I think the $3.3 trillion was always a negotiating position. We certainly should have done stimulus in the summer. We would have come into this difficult period with a stronger economy. We would have had even more rapid growth. We would have helped a lot of children who are going hungry. We would have prevented a lot of layoffs from state and local governments. But look, David, what's important now is to look forward, not backward. And you saw it in today's employment figures. You see it in what's happening with COVID. This economy needs relief, and it needs it now. It needs it for hungry children. It needs it for people who are unemployed. It needs it to compensate those who are going to need to stay home if we're all going to stay safe. It needs it to pay for much more testing than we're having. It needs it to pay for more contact tracing than we're now doing. It needs it to pay for the monitoring and assuring that people are wearing masks. And it needs it to make sure that we deliver those vaccines every bit as rapidly as we conceivably can. This cannot possibly be a moment for sitting still. It would be the highest irresponsibility if Washington was not able to find a compromise. That means cutting out peripheral issues that may be very important economic issues, but are not central to the stimulus challenge. And it means getting with the program and recognizing that America needs help. I hope it will happen in the next several weeks. It looks more likely than it did, but there are no certainties. And it is a real test of goodwill and the capacity of Washington to function.
Larry, one of the things we like to do here on Wall Street is look at the week, but also look beyond the week to larger patterns here. And when anybody mentions a paradigm shift for me, it certainly gets my attention. I read that book a long time ago about paradigm shifts. And there's suggestion there may have been a paradigm shift when it comes to fiscal stimulus. It comes from Olivier Blanchard referring to you, saying that there might be a paradigm shift. The large agreement between Larry Summers, Jason Furman, Ben Bernanke, Ken Rogoff, and him. Tell us about that paradigm shift.
I think the paradigm shift is one I've talked about on your show before, David. For 40 years since the inflation of the 70s, the preoccupation of macroeconomic policy has been with monetary discipline to avoid inflation and fiscal discipline to prevent crowding out. Now, when we've got zero interest rates and zero interest rates projected for a very low interest rates projected for a very, very long time, we're in a different paradigm. We're in a paradigm where the challenge is absorbing all the savings that an unequal and uncertain private sector generates. And that means we're going to have to think about fiscal policy not just as a counter-cyclical tool, but as a chronic instrument that we're going to need to use to maintain demand. If we don't have fiscal policy, we are going to have pathologically low interest rates. We are going to have, with those pathologically interest rates, savers who don't have a chance to make it for their retirement, exploding asset prices and potential financial instability, rising inequality, and economies that aren't going to reach their full potential. So the right way is to provide more stimulus to the economy, and we probably can't provide it with monetary policy, and even if we could, the side effects would be catastrophic in terms of financial instability. So we need to think about fiscal policy as a permanent tool of maintaining demand management. That is a very different view than the one we've had. It may well not be the right view forever, but it's the right view for coming decades.
So apply that approach to fiscal policy, which would be a paradigm shift, as you say, to what we're facing right now, what Roger Altman earlier in this program referred to as a split-screen economy, where we're looking at 3-4 months of really tough times, perhaps with a snapback if a vaccine is widely distributed toward the middle to the end of next year. Can we have one fiscal policy that handles both of those very different conditions?
I think so, because even with the snapback, even with a very good period of growth, we're still going to be short in terms of total number of jobs of where we thought we were. We're going to be short in terms of output of where we thought we would be. And we are going to need to run deficits of a kind larger than people used to think were appropriate. And the truth is it's going to be okay, because we're going to be able to run those deficits given how much savings there is to absorb them and given how little pressure there is coming from credit markets. So I don't think this is an alarming prospect. In many ways, low costs to borrow for public investment are a boon, are a good thing, just like businesses regard low borrowing costs as a good thing, and all of us as homeowners regard the ability to refinance our mortgages, the ability to get a larger home or a second home at a lower carrying cost because of low interest rates. We regard those as positive things, and the same thing is operative in terms of public investment. So I don't think of this as necessarily a bad thing. Low interest rates are an opportunity to do all kinds of things we probably should have done a long time ago, whether it's green investment or investing in our children or fixing our infrastructure. I've used this example before. When I started flying from Harvard to Washington to give advice, it took an hour and a quarter. Now it takes over an hour and a half, and it hasn't gotten any further, and airplane technology hasn't gotten worse. What's gotten worse is our air traffic control system's ability to manage all the traffic. That's got to not make any sense. That is one of many, many examples of where we need to strengthen our country's infrastructure. Another example is our kids who are not able to go to school and in so many cases don't really have decent access to education because they lack the broadband access that is kind of part of being part of the economy in the same way that electrification was a necessity to be part of the economy a century ago.
Okay, so Larry, just in a little over a minute left here, I want to do a couple of quick summer says that we'd love to do. Number one, when are we going to have a vaccine which is so widely distributed it affects 70% of the American population? When will that happen?
June 1st.
That's pretty bullish. But is that the second inoculation or just the first?
Second inoculations for enough of the population that COVID will be down 85% from current levels by June 1st, is my prediction. I mean, there are people who are saying we're going to get a third of the way by February. And if we come close to that, we'll get the rest of the way for sure by June.
Well, I, for one, would take that deal without a question.
I'm an optimist on this.
Well, I like your optimism. That's terrific, Larry. You've been warning us about COVID-19. It's good if there's a way out of this. Second one, when we're going to see the 10-year yield up about 1.5%, we really saw it move up significantly this week.
I think that's going to be until next year. I don't think the Fed's going to want to see that happen. I think there's going to be a lot of pressure to keep rates low, to maintain financial stability, and make sure that we're getting all the stimulus to investment that we can. February 1st, 2022.
Oh, 2022. By next year, you mean 2022, not 2021.
Yeah.
Yeah, exactly. But does that mean the reflation trade may be oversold?
As a possibility, no. There's a lot more room above 1% than there is
That's fair
below
enough.
where we are now.
Fair enough.
But I don't think it's a good short-run trade.
Thank you so much to special Wall Street Week contributor Larry Summers of Harvard. Always so great to have him with us. Finally, one more thought. The irresistible force of COVID meets the immovable object of American football. All of our lives have been upended in ways we could not have imagined just a year ago. But it's one thing to work from home, or miss graduations and family gatherings, or forego vacations. It's something else altogether to do without our football. So the NFL came up with a plan to push ahead, to test everyone daily, wear masks even in practices, limit all outside activities, and punish anyone who doesn't comply. The only problem is football is played by people. And people don't always play by the rules, even in football.
They had a good protocol, good strategy in place. But at the end of the day, they're working with people, and human beings make errors.
And so this week, we had the Pittsburgh Steelers play the Baltimore Ravens on a Wednesday afternoon. The third time the game had been rescheduled because a good part of the Ravens roster tested positive. And the Denver Broncos lost all of their quarterbacks, not to COVID, but to violating the rules on COVID, leaving a wide receiver to run the team, one who hadn't taken a snap under center since his days in college at Wake Forest. It would be easy to say, just stop playing. But as Hall of Fame cornerback Darryl Green put it, it's not just about a game. For many of us, it's about who we are.
How can we keep moving certain things that has to continue to move, that makes us who we are as an American society?
So whether you love football the way some of us do or not, we all share the need not to let a virus that's changed what we do change who we are. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.